Let us talk about cycles. Long cycles, psychological cycles, capital cycles, and more importantly, lens cycles that repeat with unsettling consistency across generations. What you're looking on the screen is not a trading indicator. It is not a technical pattern. It is a structural map of boom, excess, collapse, and recovery. This framework is often referred to as the 18-year real estate and credit cycle. The most dangerous mistakes investors make is assuming this time is different. It never is. Let's begin with the top chart. Title The 18-year cycle. This chart must be read from left to right. The horizontal axis represents time and economic progression, recovery, expansion, peak, collapse. The vertical represents escalating land prices, not productivity, not innovation, not earning. That distinction matters because land does not produce cash flow. Land absorbs speculations. So, step one, recovery phase. On the far left, you see periods labeled deep recession, 1955 to 58, 73 to 76, 91, 94, 2009, 2012, and the projected 27, 30, 2027, about 5 years next year. These are the moments when credit contracts, speculators are wiped out, land prices reset, and pessimism dominates the headline. That is when capital is rebuilt quietly. As you move right, the line rises gradually. This is productivity expansion. Lending resumes, wages stabilize, construction returns, and confidence grows. This phase feels boring. That is why most people ignore it. That is where fortunes are seeded. And then step number 3, midterm recession. Halfway through the cycle, you see a dip in 1962, in 1982, in 2002, and 2022. These are policy-driven correction, not systemic collapse. They flush leverage, but they do not reset the system. And then, of course, now look at the red highlighted section labeled the winning curve, and totally to the right. You are here. This is the most dangerous phase of the entire cycle. This is when prices accelerate faster than income. Speculation replaces valuation. Debt is justified by permanent demand. And everyone feels smart. The years listed here are critical. 1953, 1971, 2008, 1989, 2007, and 2025 to 2026. This is not a coincidence. This is pattern recognition. The winners over-leverage, overextend, and overstay. And that is why it's called the curse. At the far right of the top chart is the cycle peak. 54, 72, 90, 2008, 2026. And that lies I tell my Patreon channels members all the time, is this is the final year. After that, we're off to the races on the way down. Immediately following each peak is a deep recession. Not a soft landing, not a gentle reset, no painless deleveraging. Why? Because land speculation is funded with credit, not cash. And when credit reverses, it reverses violently. Now let's move to the bottom chart, the brownie one. Titled Periods When to Make Money. This chart is psychological. It divides years into 3 categories. Category A, which is a panic years, 1927, 2019, 2035, 2053. They are transition years, not bottom. They are a moment of fear, policy shift, regime changes. They often confuse investors because prices can still rise afterward. Now, this is the most important section, category B, which represents high prices. what's going on with category B? High prices, peak optimism, and the time to sell assets of all kinds. Notice the highlighted year, 2026. We're entering that year. This aligns perfectly when the cycle peak in the top chart. That conversion is rare and is dangerous to ignore. Then you have the hard time, the buy zone. Category C, look at the finger. Low prices, forced liquidation, distress, and the best long-term buying opportunities. What I'm going to do for my subscribers, I'm going to pinpoint when it's time, at least for myself, when it's time to get out, and then it's time to get back in. Again, we buy, we sell when everybody else is buying. Right now, everybody's buying, so you have to decide when is the time to sell. This tells us something critical. The transition from C to B is violent and short-lived. Smart money buys early and sells into euphoria. Dumb money buys late and prays. Why this matters now? We are currently standing in the exact overlap of the winner's curse. Category B, selling years, cycle peak timing, maximum policy distortion. This is not about predicting a crash tomorrow. This is about understanding risk asymmetry. Aside from here, the upside from here is really limited. The downside is not. Every cycle ends the same way. Excess leverage, political blame, regulatory backlash, and monetary reversal. Look at 2007, look at 1989, look at 1971. Each time the asset looked unstoppable. That was justified. 2007, I know I was there on Wall Street. Central banks were trusted and warning signs were dismissed. This is the die of the leverage. Final warning. This chart does not tell us what to buy tomorrow. It tells you what not to ignore today. Cycles reward patience. They punish greed. And they destroy those who confuse luck with skill. If you understand where you are in the cycle, you do not need predictions. You need discipline.